Your focused exposure at the moment, China, Taiwan, Vietnam, and South Korea. A pretty interesting story for each one. But let's kick off with China there. And of course, what Chinese market does is, at least from my observation, is that there is this very parabolic sort of a tactical move upside, and then it actually enters this very depressing interim period. Is that going to continue, do you think, or are you betting on that cycle and enjoying the ride around the volatility?
So in China, we're very much focused on stories where we have earnings visibility. One example would be Huahong. I've spoken about it previously. That's the second largest semiconductor company in China, and it's specifically focused on the mature nodes. So there's tremendous amount of demand for that internally in China, and it's a focus for the government. First quarter sales were up 18%. Another one would be Tencent. We have great visibility into earnings. It's a globally diversified company. First quarter numbers were up 18%. So there are places where you can focus on the bottom-up earnings visibility with fairly compelling valuations.
Mandy, comment on this.
Yeah, absolutely. I'd love to come in. I'd love to get your thoughts there on what Jim O'Neill was saying. And he makes an excellent point. You know, we always talk about, the demise of the dollar every single time that it, has a sustained period of weakness. And he was obviously saying, look, we've been, revisiting this theme multiple times over many decades. But yet, what do you think about that? Because what happens with the dollar has big implications, obviously, for emerging markets as well.
Absolutely. I mean, the dollar, the currency impact on emerging markets has been incredibly significant for the past 10 plus years. So much of the local gains have been wiped out by currency translation. So if we do see any stability in the dollar, that would be positive. If we see dollar weakness, that would be massively positive for emerging markets. And look, this year the currencies are strong. Half of the returns in emerging markets this year are coming from the currency. So I think at the end of the day, it's about positioning. In the past 10 years, we've seen 80% of flows going to dollar-denominated assets. We, again, don't need to see a massive reversal, but a small shift reallocation or just stability in the global flows will go a very long way to emerging market returns.
And Sherry mentioned South Korea, which is a market which has done actually very well to date and outperformed the S&P and I think even Europe. But, when you're an exporting-oriented emerging market like South Korea, you don't want a particularly strong or strengthening currency because it obviously undermines your export competitiveness. Is there a point at which emerging market currency strength, because by default the dollar is weak, it's going to cause a problem?
So absolutely, for some countries, that could potentially be a risk. But by economic theory, no matter how you slice and dice, these currencies are vastly undervalued. So there is definitely some strengthening that could come in before we see pain. So I would say that would not be a significant risk.